Gibson, I want to get your thoughts here on yesterday, because the market overall is throughout this month so far has kind of pivoted back to the well, it seems, going towards policy as the driving force. I say that because our reopening trades have slowed a little bit. The NASDAQ growth companies are back and bonds are firming up within the range they've been in. So what is behind this? I mean, is Jay Powell telling us anything really meaningfully new? I know he's tweaked some words and he's extended some of that language, but in effect, are they doing anything differently?
You know, I think Powell's done a really good job of communicating. There was no change in the asset purchase program yesterday, and the Fed made it very clear that they're a little concerned about the economy, although they see greater prospects on the horizon. I think this form of moral suasion that they're entering into right now and reminding the bond market, reminding markets that if things do slow down, that they will be there for the markets, is really part of their protocol. And I think I applaud them for not doing anything yesterday in terms of extending the purchases and or the duration of the portfolio. And I think they stand pat, ready to act, and we'll have to wait and watch and see. And I think one other interesting thing with the Fed, and if you really pay close attention to Powell's comments, he continues to redirect the fiscal, redirect policy back towards government and fiscal policy. And I think it draws the market's attention even more to what's happening in Washington and whether or not we're going to get another package. Okay.
Now, Gibson, the fiscal talk and that type of stimulus has had a little bit of a different market impact compared to the monetary side. Both have generally been dollar negative. But when we see fiscal talks and that type of stimulus drive action, it's a little bit more geared towards the businesses, the companies, the sectors that need it. It looks a little bit more like a kind of natural recovery where you'll get bonds to drop too for the most part, the yields higher. On the Powell side, that's where it seems that something there is working its way in, because we've got the bond market kind of firming. Even though we've got all this vaccine potential, we're still under the yield that we were in June. Gibson, how's that possible? I mean, our entire outlook shifted in a monstrous way when we got these vaccines, didn't it? How can we possibly be trading with an outlook that demands a lower yield than we did in June when nobody knew when this thing was going to end? We know it's going to end next year.
It is. But let's not forget that the Fed is in buying treasuries on a daily basis. And so this morning, the Fed is in buying the long end of the market. So this market manipulation continues. I mean, we're working in artificial markets in many ways, but predominantly in the fixed income market where yields are being contained. This is all part of quantitative easing. It's part of the current policy position by the Federal Reserve. So interest rates don't necessarily reflect the, call it, exact consensus view, which is a second point, which I think is absolutely critical here. The market is so anchored on this consensus view that there's tons of stimulus in the system, the economy is going to improve, things are going to get back to normal, we're going to see economic growth both domestically and globally, earnings will follow, and then ultimately we're going to have higher rates and a steeper curve. I personally think that is going to happen, but the timeline is probably longer than the markets are expecting. And that leads us to a position to where the consensus is so strong right now that any issue, any surprise, any kind of exogenous event will create a significant volatility in markets. And I think we have to watch the bond market really closely for cues on that. It is definitely setting the foundation for risk assets right now.
So Gibson, one of the things here that's interesting is, the idea of whether or not the Fed plays a big role in terms of its policy being additive or consistent. I mean, that's where I kind of have this hang up still, because they're not adding anything new. They're keeping the bond purchase programs exactly where they are. They have said they're going to do that basically ad infinitum until something really forces them to not do it. Who expected them to really say that we're going to set some timeline for tapering and something? Nobody ever thought that Powell is going to do anything like that, right? He's going to stand by the bond purchases. But what does that mean for the market if they're not adding more? For years, at any part of the decade, the past 10 years, you could basically pick a point and say 6 months to a year from then, the amount of stimulus from the Fed was going to increase. Does that derivative not matter? That kind of second order effect is keeping stimulus every month going in at the same rate as good for the market and as good for bonds as piling up more stimulus every month?
Well, I think they have to keep some powder dry. I mean, if we think about the stimulus that's in the system right now, 3-4x of what we saw in the great financial crisis, and coming to us in a much faster fashion than what we saw back then. So the Fed has really done its job. They have to be a little careful here in that, we have uncertainty on the horizon. While we all want to believe the economy is going to get better and things are going to return to normal and the vaccine solves all the economic problems, the reality is there will be issues in the future. There will be surprises. The Fed's next or maybe even last policy tool is yield curve management and really managing the long-term rates to keep stimulus in or liquidity in the system. And I think they're really being smart in not executing on that strategy right now and really pushing it back to fiscal stimulus and fiscal focus. One other thing on the fiscal side, which is absolutely critical, and I have to believe that Powell is thinking this. When we talk about fiscal stimulus, it's not just additional stimulus from the government. There has to be policy change. The government really has to come together and change policy that incentivizes employment, small business origination, infrastructure spending. Those are the next elements, in my opinion, that really lead to longer sustainable growth and ultimately give the Fed the ability to step back and pause. I'd say one last thing as it relates to the Fed, and I think this is really critical. We have experiences of the Fed trying to take the foot off the gas. If you recall, they looked at the market and they said, we are going to raise rates and we're going to shrink our balance sheet. It did not end well for the Fed. I think they will approach the market with more caution in terms of their policy, a much longer term view. And the first thing they're going to alter are the asset purchases. And I think we won't get a cue on that for another 12, maybe 18 months. And God willing, hopefully the economy continues to improve and the Fed is in a position to where they can actually have those conversations.
Okay, so there's still enough cracks basically for them to keep pouring everything in. It seems that Powell wanted to spend yesterday a lot more time talking about the weak points of the economy than the strong ones. Obviously we see this morning with jobless claims too. There's still weakness there. So Gibson, if the overall situation for the Fed is a consistent one, they're not adding more, but they're also not taking anything out anytime soon. What does that mean for bondholders and what does it mean for bond investors? Is there still that kind of recovery risk to being long duration bonds, or has something shifted now where maybe the yield move we had over the last 4 months can pause? I mean, it was Powell's message that big yesterday to where this 4-month climb in yields in the 10-year can stop or reverse?
Yeah, well, remember, we are still at yields below levels, prior to the crisis. And
right.
If we think about every incremental positive that we get around global growth and domestic growth, that probably puts more fear in the bond market that things are going to normalize. And we step back and we think about interest rate adjustments and yield curve adjustments being probably the biggest risk that fixed income investors face in 2021. And I remind investors all the time, though, that this is so strongly in the consensus view right now and so anchored in the consensus view that anything that goes against the economic recovery really puts the bond market in a position where you could see a very significant rally. So we're going to be in a market of fits and starts. I think bond investors have to show a level of caution around rates going higher because durations are so long and the drawdown risk is quite significant. And remind them again that rates were higher pre-COVID and we have a massive amount of stimulus in the system, a massive amount of liquidity. And as things progress, the positives lead to more positives, the flywheel gets going. Next thing you know, we could see significant economic growth.
So is this, just to kind of wrap things up here, this 4-month trend of yields steadily climbing, is that going to slow down, do you think, now? Has the message been strong enough to push yields either sideways or lower?
I think what we're seeing on the economic data front, both domestically and globally, a lot of it being influenced by the increase in cases, the kind of regional shutdowns that we're seeing. I think in the near term, there's going to be some caution and yields are probably range bound in the near term. But again, every incremental positive data point we get around economic recovery and sustainability of that recovery really puts the bond market in a more vulnerable position to higher rates and a steeper curve.
Okay.